Good morning, everybody. Myself, Vivek Banerjee. I will be taking today's lecture on security analysis. First of all, I will take the fundamental analysis and then I will come to the technical analysis portion. Now, let us begin this portion on this fundamental analysis. Before proceeding to the further PPTs, let us first of all understand what fundamental analysis is, or what we do in fundamental analysis. Now, first of all, tell me what is fundamental analysis? You can make out from the heading that it is the analysis of the fundamentals, but analysis of the fundamentals of what actually? It is the analysis of the fundamentals we start with as a fundamental analysis from economic analysis. Then we come to the industry and then company. We also called it as EIC analysis, that is economic, industry and company. Now let us take a very simple example to understand this. EIC analysis or economic, industry or company. For example, if we start with economy, analysis of economy, the first thing which comes to our mind is the GDP growth rate. What is the GDP? GDP is the value of all goods and services produced in an economy. Let us say RBI has projected that the GDP growth rate will increase from the previous quarter from 6.5% to 7%. So the GDP growth rate is projected to be increased from 6.5% to 7%, say in 2024. Let us say, suppose I'm taking a hypothetical example. So what will be its repercussion? If GDP growth rate is expected to be increased, means value of all goods and services will proportionately increase. It means there will be more production will happen in the economy because company will produce more. So this will leads to more production, because by way of more production, then only the value will increase. So more production will leads to more sales, further more profitability, and more profitability will ultimately lead to companies increase in share prices. Companies increase in share prices. So, as a fundamental economist from the economic analysis, you can very well make out that because of the GDP projection of GDP growth rate increasing from 6.5% to 7%, the economy will likely to do well, and most of the industries and company are likely to do well. So your outlook will be positive. But in which industry? Then comes the industry analysis. Means you did an economic analysis, but which industries to invest? So next, then comes the industry analysis. Which industries are likely to do well? The first which comes to your mind is the sectors where the government is encouraging. The government is encouraging. You know that the government is giving a big infrastructure boost. So the sectors which likely to benefit from this infrastructure boost is you can say cement. Here comes to mind is cement, steel, uh, glass, and we can say wood. So by way of the infrastructure boost, these sectors, that is cement, steel, glass, and wood, are likely to do well. Likely to do well. So you did an industry analysis. First of all, you did an economic analysis that yes, the economy is likely to do well. There will be more production of goods and services. Most of the industries and companies are likely to do well. Then you come to industry analysis, that which industries are likely to do well. You can make out that from the general observation and from your own research that because of the infrastructure boost, certain sectors, that is cement, steel, glass, and wood, are likely to do well. Then you narrowed it down to company analysis, which companies are likely to do well. So by way of infrastructure boost, you can make out that yes, the steel industry is likely to do well, but which companies are likely to do well? So for example, you see the Tata Steel. So what you will see in a particular company, if we, for example, choose in Tata Steel. So the first which comes to your mind is the financial analysis. The company's financial analysis. And next is, which comes to your mind, is the company's management analysis. This management, and according to you, I am asking you a question that whether fundamental financial analysis is more important or management analysis is more important. My view is that the both are more important. Sometimes the management analysis gives more weightage in comparison to the financial analysis. We will see in detail when we further proceed in our lecture. So in financial analysis, you know that the company, as a fundamental analysis, you see the company's profitability position, sales position, EPS, the company's liquidity position, the company's solvency position for the last 5 to 10 years. And management analysis, you go through how the management is doing. From that, you can make out that whether to invest in that in a particular company, say for example, the Tata Steel. So this way, the entire, you can say, economic, industry, and company analysis goes. After this economic, industry, and the company analysis comes the valuation. Why valuation? Because now you want to invest in a particular company after this EIC analysis. For this, the first step as a fundamental analysis you do is uh, calculating the company's intrinsic value. So what is this intrinsic value? Intrinsic value is the present value of all future cash flows discounted by an appropriate discount rate. For this purpose, we actually estimate the future dividend for calculating interest. We will go deep into it, this intrinsic value and valuation of equity shares. But first of all, just to give you a glimpse, I am taking it briefly. So in first of all, you actually, and it depends upon whether you take dividends, you take earnings, or you take the free cash flows. So let us say, for example, you take future dividends. So first of all, future dividends are estimated. First step is to estimate future dividends while calculating intrinsic value. Then you estimate a discount rate. So the discount rate at which you will discount these future dividends. And then after discounting at this future discount rate, you come at the PV, that is the present value. Okay, so you know the concept of time value of money, present value investing decisions you did in an intermediate course. So just to give you a glimpse of this. Now come to the, you can say, PPTs again. Okay. Now you will be able to understand this slide better. That is, what is a fundamental analysis? Fundamental analysis is basically the assumption that the share prices depend upon the future dividend expected by the shareholders, as I've just mentioned. And the present value of the future dividends can be calculated by discounting the cash flows at an appropriate discount rate and is called the intrinsic value. So now you are able to understand this slide, I hope. I will take an example also. Now come to this second slide. So what is fundamental analysis? It is done by examining related economic and financial factors. So economic, you first start from the macroeconomic factors such as the GDP growth rate, as I've just mentioned in the example. And then you come to the industry, to which industries are likely to do well. If the GDP growth rate is likely to increase, then which industries are also likely to do well. Infrastructure push given by the government and the electric vehicles, the government PLI scheme, which we will be discussing later on. And further, we narrowed it down to the company analysis, that is the effectiveness of the company by judging the company's financial and the how the management is doing. Yes, there is one query from Uday Pratap Singh. Sir, does value is not increased by increase in prices? I am coming to that. If you understand this concept of intrinsic value, you will be able to understand that how the means price increase, decrease, and on the basis of intrinsic value, how a fundamental analysis take decision whether to purchase the shares of a particular company or not. Now, please read this slide. Concept of fundamental analysis. The intrinsic value shows the true value of a share. It is the shows the fair value of a share. A share, student, this is important. This second sentence. A share that is priced below the intrinsic value must be bought, while a share quoting above the intrinsic value must be sold. So, once you calculate the intrinsic value, you compare it with the current market price and you take a decision whether to buy the shares of a particular company or not. So, intrinsic value is greater than market price, then your decision will be to, then as a fundamental analyst, your decision will be to buy. Say the intrinsic value after all the calculation comes to 100 and the company's market price is 90. Okay. So in this case, the intrinsic value is greater than the market price. So your decision will be to buy. Why this is so? Because intrinsic value shows the maximum price, which will be in the future. That is, it is very likely that the company shares price will increase to 100 in future. So you will maximum price at which you will buy the shares is 100, not beyond that. Now the current at present, say for at today's date, at 21st of January, the company's market price is share price is 90 rupees. So you can very well make out that if the current share price is 90, it is very likely that it will goes to 100 in future. So it is profitable to buy at 90, and when the share prices reaches 100, it is to sell at that price and pocket rupees 10 as profit. So this way the concept goes. I will goes into this concept of intrinsic value detail in the valuation of equity shares. At this present moment is just for your knowledge that how the thing goes. Suraj, when we do the fundamental analysis entirely and when we come to the technical analysis, you will be able to understand that why the share prices fluctuate daily. Okay. So at this moment, you might not be able to understand. So let us finish this fundamental analysis and this technical analysis, and especially the valuation of equity share. Then we will be able to understand clearly why the share prices fluctuate on a daily basis. Now I'm taking a brief example for your understanding. For the calculation of intrinsic value. Current dividend is 2.5, discount rate is 10.5%, growth rate is say 2%. So intrinsic value, this is calculated by, we have a very simple formula, D0, which will be multiplied by 1 plus G, that divided by K minus G. So D0 is nothing but the present dividend. Say present dividend is 2.5 and it will be multiplied by the growth rate. So growth rate is also estimated. That is, here in this example, it is given 2%. So it is estimated that the dividend will grow at the rate of 2% every year periodically. So first of all, present dividend is multiplied by the growth rate and then it is discounted. K minus G is basically the discounting procedures. Then it is discounted to arrive at the present value. So in this example, it is 2.5 is already given present dividend. You multiplied it by the growth rate. So multiplied it by 1.02 and then KE minus G, that is, you can say this is KE minus G. KE is given to you. Discount rate is given. It is K. K, sometimes it is called KE also. And this growth rate, which is, it is G. So it is KE minus G or K minus G. So it has come to 10.5% minus 2%, the denominator. So it will be 0.015 minus 0.02. So if you solve this particular example, the answer will coming to rupees 30. Again, this is just for your knowledge. In valuation of equity shares, we will be doing detail into this. We will be doing practical problems also on this aspect, intrinsic value. Now come to this next slide. Now, it is very essential to concentrate on the underlying business performance. That is, generally the investors tends to, you can say, select those companies which are fundamentally strong. And we have many such examples. Examples are given, that is Infosys Limited, TCS Limited. Here, the example is given in front of you, that is the Infosys. Infosys Limited is given, TCS, Page Industries, Aisha Motors, Bosch India, Nestle, TTK Prestige. Other companies will come to your mind is, you can say, Asian Paints also, Dabur also, ITC, which comes to your mind, Reliance, Hindustan Unilever Limited. So these companies actually are growing on a, you can say, year-on-year basis, about 15 to 20% compounded annual growth rate on year about it on a for over at 10 years. So these are tend to be fundamentally strong companies. Now come to this next slide. That is, before proceeding in detail to in the fundamental analysis, two aspects which have to be carefully considered by the investors. First of all, general observation, and second is modes. So what is basically general observation? General observation means the first, while starting this topic, fundamental analysis, the first example I have taken. So from the general analysis, while reading the newspaper, you can see that the GDP growth rate will increase. GDP growth rate will increase. So this will affect certain industries. You can say that yes, which industries will be affected. The industries where government is giving a infrastructure, government is giving a infrastructure push. And from this, he narrowed it down to the company, which companies are likely to do well. So from the newspapers, from the various analysis or on your own research, you can say that yes, the certain companies are doing well on the basis of financials on the basis of good management practices. Now coming to moats. Moat, what is a moat? Moat is generally a term which is popularized by Warren Buffett. So, moat is nothing but it shows the company's competitive advantage over its competitors. The one thing which comes, the one example which absolutely comes to your mind is the, you can say, Eicher Motors brand Royal Enfield bikes. So even if the prices of brand Royal Enfield bikes increases, you tend to purchase that. For example, you can say Royal brand Enfield bikes are, you can say 5 lakh. The cost is 5 lakh. I'm taking a certain example. And even if his cost is increased by 5, मतलब एक रॉयल एनफील्ड बाइक की कॉस्ट अगर 5 लाख है, तो वो अगर इंक्रीज होकर 6 लाख भी हो जाती है, तो जो एक्चुअली ब्रांड रॉयल एनफील्ड बाइक्स के शौकीन है वो 6 लाख पे भी खरीद लेंगे, भले वो इंक्रीज हो जाए. तो ये एक ब्रांड वैल्यू और कॉम्पिटेटिव एडवांटेज ऐसी चीज है कि जो कंपनीज के प्रॉफिटेबिलिटी को जल्दी कम नहीं होने देती है. प्रॉफिटेबिलिटी कम नहीं होगी तो उसकी शेयर प्राइसेस भी बढ़ती रहेगी या उतनी तेजी से नहीं घटेगी अगर कम भी होगा तो ये एक मोट या एक कॉम्पिटेटिव एडवांटेज जो है वो इन्वेस्टर्स को ध्यान रखना पड़ता है कि अगर ब्रांड वैल्यू है दिस मीन्स द कंपनी इज फंडामेंटली strong, generally tend to be fundamentally strong, and it is likely to do well in future. Yes, Mansa, the ESG factors also impact the, you can say, company's decision making. As I have said, that I have just taken a simple example, one example. When we will go deep into it, this economy analysis, industry analysis, and company analysis in this lecture, we'll be able to understand that yes, it impacts the decision making. After this, the valuation comes. Now come to the next slide that in macroeconomic factors, that is historical performance of the company in the past and present, expectation in future, growth sectors of in the economy are likely to be assessed while analyzing the overall economy. Just a GDP growth rate. GDP growth rate is likely to be increased. Now the inflation interest rate has more or less peaked. It can be said that according to various experts. So the interest rate is likely to be decreased. The interest rate is likely to be decreased, then there will be, you can say, more savings in the hand of the, you can say, the general people. If general people tend to save more, they can invest in some profitable investment opportunities. So these factors are also to be taken into account. कि इंटरेस्ट रेट अब घटेगा. फॉर एग्जांपल इंटरेस्ट रेट 7% है, तो 7% से अगर 6.5% हो जाता है, तो लोन, कोई अगर लोन लेता है तो उसमें इंटरेस्ट रेट कम देना पड़ेगा. द इंटरेस्ट हैव टू बी पेड लेसर. सो दिस वे वो कुछ सेव कर पाएगा, तो जितना वो सेव कर पाएगा उससे वो फर्दर इन्वेस्ट भी कर पाएगा. तो इन्वेस्ट जहां जहां करेगा और कंजम्पशन इसमें इंक्रीज होगा, तो कंजम्पशन अगर इंक्रीज होगा तो वो कुछ इंडस्ट्री और कुछ कंपनीज पे भी वो इफेक्ट डालेगा. So this way, you can say economic analysis is done. And then if you then read the next sentence, that trends in people's income and expenditure reflect the growth of a particular industry or company in future. This is very important. Trends in people income and expenditure. How is people's income and expenditure? For example, if you see the current trend, what is the current trend? Current trend is that the income of the income of HNIs, that is high net worth individuals, is increasing. And the salary of the people of senior position, salary of senior executive means at the level of CFO and CEO, also tends to be increasing in the large companies. So, how does it affect the various, we can say, industries or various companies? Because of this, the luxury cars, the demand for luxury cars, the demand for luxury cars are increasing. Demand for luxury houses are increasing because the people who are already well off, the people who are already rich, the people who have already substantial income in their hand, substantial income in their hand, are likely to do well. So, the demand for luxury cars and demand for luxury houses both are increasing. But what about this salary of the middle classes? To see that yes, the salary of the middle classes and upper middle classes are not increasing by that proportion. So you can very well make out yes, the you can say the demand for affordable cars, the demand for affordable cars or affordable homes are not increasing and will not be increasing, likely to increase substantially over the, you can say, next few years. So this way in the economic analysis has to be done, and the people's income and expenditure plays a very important role. Now comes to the this last sentence, that consumption affects corporate profits, dividend and share prices in the market. This is also very important, that consumption, when consumption will increase? Consumption will increase only when the demand increases. Okay. People will consume more, people will purchase more items only when the demand increases. When demand increases, demand will increase when the people's income increases. If people's income decreases, then demand will not increase. If the people's income increases, then the demand for goods will increase. If the demand for goods will increase, more production will happen, more consumption will take place. If more consumption will take place, the company will be able to sell more. If the company is able to sell more, then it will gain profits, and profits will lead to higher share prices. If the share prices are higher, the company will be happy and then will reward the investor for their patience and will declare dividends to them. So this way, consumption also plays an important part. Mansha is depends. We will come into it, that real interest rate and nominal interest rate for uh, if it depends upon the investor. If you want to inflation adjusted investment, then he will consider the real investment. If he wants to include the inflation part, it will go with the nominal. So you can say this is not a hard and fast rule, and you will able to understand once this lecture is over. You will able to understand that yes, which is the right way. Per capita income of Suraj is asking, per capita income of people will affect the industry. Yes, per capita income also. That is why if the income increases, for example, if the particular sectors of the people, the general salary increases from certain sectors 20 to 25,000. If salary increases from 20 to 25,000. So this 5,000 boost will actually tend the people to actually, you can say, consume more. As I've said that if consumption increases, then the company's profitability increases, its share prices increases, then the company will also declare more dividend to the investors. Investors will also gain by way of capital gain. जो shares कम पे खरीदे इन्वेस्टर्स ने उसको ज्यादा पे बेच के वो कैपिटल गेन भी उसको हो सकता है. तो yes, this per capita income also affect the industry. Now coming to the factors affecting the economy analysis. The growth rates of national income and the related measures. So growth rate of national income, you can see the GDP. So GDP, I have just discussed. If the GDP growth rate is likely to do well, so it will affect various factors. If GDP increases, then it shows that there will be more production taking place. On the other hand, if GDP rate is likely to decrease, the company will be reluctant to produce more. If the company is reluctant to produce more, there will be, you can say, more unemployment, job losses, you can say salary decrease. So if the people's income decreases, then consumption will also decrease. They will be likely to purchase less. And then that will also affect the company's profitability and consequently the share prices also. Now come to the growth rates of the industrial sector. Growth rates of the industrial sector, I have also already discussed that which industrial sector is likely to do well because of higher GDP growth rate, for example. The sectors given infrastructural push by the government's PLI scheme, that is production linked incentive schemes. Electric vehicles, the government is giving push to the electric vehicles. So those companies which are involved in the electric vehicles are also likely to do well. So these sort of analysis the fundamental analysts make. Inflation is also you can say, plays a very important part. How? If the inflation is, you can say, moderate, there is moderate inflation. So moderate inflation is actually good. You know that moderate inflation is good. How moderate inflation is good? Because the company will be able to sell at higher selling prices, and that will also increase its profitability, and will be able to sell more, increases profitability, and consequently its share prices. But too much inflation, very high inflation, very high inflation is actually bad for the people also, and bad for the companies and the whole economy also. How? Very high, if the inflation is very high, for example, the inflation increases from 6%, so you can say 8%, 6% to 8%, 9%, or even 10%. So people with such high prices, people will likely to purchase less. If the people purchase less, then the company will produce less. It will lead to more job losses, and people will get less salary. Consumption will be less, company's profitability less, and this will also affect the company's share prices. So inflation can be analyzed in both these ways, and inflation also plays a important part in economic analysis. Monsoon also affect, because still India is dependent heavily on monsoon. So monsoon actually, you can say, affect the agricultural goods, or you can say the sectors which are related to agricultural goods. For example, you can say fertilizers, pesticides, yes, etc. Okay, so monsoon also plays a important part. Yes, Mansha, hyperinflation is very high inflation. Now, techniques used in economic analysis. The first technique used is anticipatory survey. Anticipatory survey is basically a survey done, and it is generally executed by the experts. And they, after the survey, they give their opinion on the construction activities. They give their opinion on the construction activities and expenditure, especially expenditure on the fixed assets. That whether the expenditure on the fixed assets, the plant and machinery, will increase or not, level of inventory. If the economy is doing well, then all these activities will increase. If the economy is doing well, then construction activities will also increase. Expenditure on various fixed assets will increase. Company will likely to, you can say, make more inventory. ज्यादा से ज्यादा इन्वेंट्री वो अपने पास रखेगी कंपनी, अगर कंपनी को ये लगता है कि हाँ सेल ज्यादा होगा. So all have a definite bearing on the economic activities. Also, future spending habits of consumers are also taken into account. So future, but how to judge this? It is generally judged by the anticipatory survey or by the recent trends. And future spending habits can also be judged by way of the how the projected GDP is there. If the GDP growth rate is projected to be higher, if it is very likely that the interest rate will not be increased further, as in the current scenario, it is most likely that the interest rate will not likely to increase further in these current circumstances. So by this way, the future spending habits of the consumers can be taken account. Yes, the GDP growth rate is likely to be increased. The interest rate are not likely to fall down. It means there will be more income in the hands of the people. So people will be likely to spend more. So you can say the future spending habits as a fundamental analyst can make out that yes, the spending will be more in comparison to the present. But obviously, it also depends upon the other factors also. Now come to the next, which is the barometer or the indicator approach. In barometer approach, where indicators are generally used. So these indicators are leading indicators, coincidental indicators, and lagging indicators. So what are leading indicators? Leading indicators means which lead actually. So what are the factors which lead? First of all, which comes to mind is the GDP. GDP growth rate, leading indicators, because everything is related to GDP growth rate. So if GDP growth rate is increasing, then it will affect the industry also. Industries are also likely to, most of the industries are also likely to do well. Now come to coincidental indicators. So leading indicator also tells us what the economy will be in future. Okay. Coincidental indicators indicates what the economy actually is. What the economy actually is. So what coincides? Generally, coincidental indicators, I will give you one example of coincidental indicators that the okay. Now the personal income generally coincides with a stronger economy. Okay. So personal income generally coincides with a stronger. Just give me a second. Coincidental indicators. Coincidental indicators. Okay. So personal income coincides with the, you can say, stronger economy. Personal income coincides with the stronger economy. So this is what coincidental indicators is. Next point is lagging indicators. So lagging indicators generally dependent upon the leading indicators. So if the leading indicator is GDP growth rate, if the leading indicators is GDP growth rate, then the lagging indicator will be the unemployment rate. Will be the unemployment rate, because higher GDP growth, lower GDP growth rate will bring very likely that their unemployment will increase. Because as you have seen, that this is the entire chain, that lower GDP means less production means less consumption, less profitability, less sales, and decrease in the company's share prices. Now come to the economic model building approach. What it is? In this approach, a precise and clear relationship between dependent and independent variables is determined. GNP model is sectoral analysis used in practice through the use of National Accounting Framework. So first of all, in this, the GNP is calculated. So what is GNP basically? GNP is the GDP plus the income from foreign investments. So total demand is estimated. First of all, total demand is estimated. On the basis of total demand is estimated on the basis of inflation, changes in economic levels, then on the basis of two above, individual components of GDP are estimated. Individual components of GDP are estimated. Then you come to the fourth point. Then again, on the basis of two above, individual components of GDP are estimated. Then when total GDP is found out on the basis of the individual components, and this can say conclusion is verified with the report of an expert. Okay. So in this economic model building approach, what it is done, first of all, GNP is calculated. What is GNP? GNP is basically GDP plus the total income from foreign investments. So GDP is calculated on this basis. Present GNP is calculated on, then the total demand is estimated. So total demand in the economy is estimated on the basis of inflation, changes in economic levels, etc. After that, the individual components of GDP are estimated. Individual components of GDP are estimated. On this basis, the total GDP is found out on the basis of these individual components. And then this estimated total GDP is compared with the opinion of an expert. And then it is confirmed that whether this estimated GDP found out on the basis of this economic model building approach is correct or not. So this is the method. Now, students, just let us try one multiple choice question, that which of the following is not a technique used for economic analysis? Try to attempt this question and give me the answer. Which of the following is not a technique used for economic analysis? Yes, come on. I am waiting for your answer. If anyone likely to like to attempt this MCQ. Fine. Most of them answer is for C. Yes, the input output analysis. Input output analysis I will discuss further, but from the other three, you can easily make out that this is not part of the economic analysis because I have discussed anticipatory surveys, barometer approach, and the economic model building approach. So C is the correct answer that it is not a technique used for economic analysis. Okay, well done. So let us proceed further to industry analysis. After the economic analysis, when an industry grows, it is very unlikely that all the industries in the economy will grow at the same rate. So it is necessary to examine industry-specific factor in addition to economy-wide factors. The first factor which comes to mind is the product life cycle. The company's product life cycle. So I am now considering the various factors which affect the industry analysis. First is the product life cycle. Let us try to understand this. Product life cycle. So life cycle can be divided into initial stage, next is expansion stage, then stagnation stage, stagnation or you can say maturity, and next is decline stage. Decline stage. So the industries which in the initial stages are, you can say AI, that is artificial intelligence and robotics. In India, it can say that yes, it is in the initial stages at some stages. And expansion stage, electric vehicles, EV. Electric vehicles few years ago was in the initial stage, but now it is in the expansionary stage because the government is giving big push to the electric vehicles. There are various, I can see that various charging stations also being built for the electric vehicles. So electric vehicle market is in the expansionary stage. Now, what are the industries in the stagnation or maturity? Means they have reached a maturity stage. Means uh, it is very unlikely that they will likely to grow at a fast pace. That is called the maturity stage. मतलब एक वो you can say स्टेज आ चुकी है जिसके बियॉन्ड वो इंक्रीज करने की जो पॉसिबिलिटी है फर्दर रैपिड ग्रोथ की पॉसिबिलिटी कम हो जाती है ग्रोथ होगा पर वो धीरे धीरे होगा स्लो ग्रोथ सो व्हाट आर द इंडस्ट्रीज most of the industries are, you can say, in the stagnation or the maturity stage. You can say the pharma sector, some companies in the pharma sectors, some companies in the FMCG sectors, some companies in the, you can say, automobile sector. Automobile sector, which are going with a, means giving a push to electric vehicles are in the expansion stage. So you can say these companies are in the stagnation or the maturity stage. Now come to decline. Which are in the declining stages? Declining stages, come to mind that which are the 830, 830. So what are the companies which in the you can say what I was saying actually declining stage. So it is CDs. You can say DVDs also, which you can say are declining. Any other example? Can say mobiles, mobiles with keypads. So mobiles with keypads. Okay. So these are the industries which are in the you can say, declining stages. Now come to the second point, which is demand supply gap. Demand supply gap is also very important. If there is a demand supply gap, then the prices of such a goods or commodity is likely to increase in future. Any product which comes to your mind, it happened, I will give you example. It happened in 2020 when lockdown was announced. In such cases, the demand for sanitizers increases suddenly because the sanitizers and mask also was actually out of the shelf in many medical stores. So when there is a sudden demand and the supply is less, then the prices are bound to increase, and such companies are likely to profit from such situation. So demand supply gap also plays an important role. So as a fundamental analyst, you can see that which are the companies where demand is likely to be higher than supply in future, and such companies are likely to be invested. Viraj, input output analysis I will be taking. Uh, is industry analysis part of the, you can say, micro environment? You can say that yes, the industry is part of the, you can say, micro, because GDP is a macro, so industry is a micro environment, part of the micro environment. You can say that. Basic mobiles, yes, mobiles with keypad, basic mobiles are also in the declining stage. Good. Now, barriers to entry. What are the industries which are having barriers to entry? The first example which comes to your mind is Geo. Few years ago, there were many competitors in the mobile servicing space, but now this mobile servicing, Geo is the leader. Airtel is, you can say, distant second. Uh, Vodafone Idea, to know, that is not doing well at all. So in this case, there is a barrier to entry, or you can say this barrier to entry and this state of competition in the industry. These two are actually interrelated. So state of competition, barrier to entry, both are very less in this mobile servicing. But in case of mobile companies, the competition is fierce. There are many players who are doing well, and there is very cutthroat competition. There are various players. You know that there is Oppo, there is Vivo, there is Samsung, and Apple. You know it is always there. So competition, I'm giving some of the examples. There are various players also. Then a very cutthroat competition. Redmi is obviously always there. Okay. So so what is the conclusion? As a fundamental analysis, the emphasis should be to, you can say, go through with such industries which have, in which the state of competition is more or barriers to entry is less. Because if there are more companies, there will be more competition. If there is more competition, then that will ultimately lead to their more efficiencies of such companies increases. So that will lead to more profitability and higher share prices in future. So the emphasis of the fundamental analysis is to invest in such companies where barriers to entry is less and state of competition in the industry is more. Okay. Yes, Suraj, railway is also a barrier to entry, but it is actually in the government sector. Once the railway is privatized, we can say that we can analyze that whether it is barriers to entry is less or more. So in government sector, barriers to entry will always be, obviously be less. Okay. Now, government attitude. Student, it is a very, very important factor that which sectors to invest. As I've just said, government's infrastructure push. I will take a separate slide. I will take its separate sheet to actually explain it. Government attitude. Government attitude means which sectors the government is actually encouraging. Infrastructure. Infrastructure is government is giving a big boost because there is revamping of the railway stations, there is revamping of the airports, there is revamping of the ports. Various shipbuilding measures have been taken. Highways are being built and still being built. Various bridges have been built. Metro trains have been expanded. So big infrastructure push, and it is likely to continue in the future also. So which sectors are likely to get profit from this infrastructure push by the government? The things which used in infrastructure or which used in the, you can say, various infrastructure projects. Cement is used, cement sector, steel, iron ore, glass, wood, and various real estate companies also, because the project will be given to such real estate companies. So real estate companies also. So these sectors are likely to do well because of the government attitude. And then comes the government's PLI scheme. PLI scheme. PLI scheme, as you know, is the government's production linked incentive scheme. Production linked incentive scheme. So actually, there are 14 sectors covered in this government's. There are there are actually 14 sectors covered in the government PLI scheme. The main sector which covered in the PLI scheme is that you can say mobile manufacturing and critical drugs, steel, medical devices. So in this production linked incentive scheme, the government is giving incentives, or you can say subsidies, to those companies, local domestic manufacturing companies who are manufacturing mobiles, who are in the manufacturing of critical drugs, who are in the manufacturing of steel, who are in the manufacturing of medical devices. So these sectors the government is giving incentives. So these sectors are most likely to do well in the future because of this government's production linked incentive schemes. So these sectors are also likely to do well. So sectors which are given by a big push by the government's, you can say, scheme incentives, you can say big infrastructure push, and the government's PLI schemes. Now come to cost conditions and profitability. The sixth point. Any question? Yes, Mancha. Yes, the government is also promoting PPP, that is public-private partnership, in the aviation sector. Yes, the aviation sector is also so likely to do well because of government is also giving a big push to the aviation sector also. The various new airports are being built, and the airports which are already existing is also giving a, can say, a push to revamp themselves. So yes, there's also a good point mentioned that public-private partnership in the aviation sector. Now come to cost conditions and profitability. This is also an important part in industry analysis. Cost conditions and profitability. Okay. Now, how to judge the cost conditions of a particular industry? The main thing to see is that the companies, you can say, industry, the raw material basically is cost. That is, what is the particular, you can say, cost on raw material, expenditure on raw material, labor, you can say, overhead. Then the products, product price, production capacity also. This is also very important. Production capacity. How much production capacity is idle? How much production capacity is actually functioning? This is also an important factor because if most of the production capacity is idle, then this is also a red flag on part of such industrial sector. So these are the where as the cost conditions and capital expenditure, another important factor. Capital expenditure for maintenance. So cost condition, what are the factors to be taken care of? The company's raw material, the particular industrial sector, raw material, labor, overhead, product price, production capacity, how much is idle, how much is functioning, then the capital expenditure for maintenance, because initial capital expenditure also important and further capital expenditure for maintaining the plant and machinery, that is also an important part. So that also has to be taken care of by the fundamental analyst. Now come to profitability. Profitability, what to see in profitability? You can say the main things which comes to mind is companies. You can say sales, company sales, profitability, company sales, profitability, ROE. ROE basically company's return on equity or ROC, that is return on capital employed. I will take you through a particular example. See, uh, is this visible? I think, I hope it is visible in front of you. अशोक जी ये visible है screen? अशोक जी टाटा कंसल्टेंसी सर्विसेज का ठीक है थैंक यू अच्छा ये टाटा लेट अस सी दिस टाटा कंसल्टेंसी सर्विसेज if you see the company's ROC here, look at my cursor that this ROC is return on capital employed in case of Tata Consultancy Services 58.7%. This ROE return on equity 46.9%. And if you see the company's sales and profitability, the compounded sales growth, this portion, 10 years, 14%. So near about 15% last 10 years. Profit growth, it is 12%. Return on equity last 10 years also 39%. So on the profitability count, this company is doing well also. And from cost also, if you see the cost factor, you have to go through the balance sheet regarding raw materials, overhead, production capacity, idle capacity, operating capacity, and the capital expenditure and maintenance. Okay. Now come to, okay, thank you. Now come to technology and research. This technology and research is also a very important factor because वो कर रहे हैं artificial intelligence and robotics. Artificial intelligence and robotics play a very important part in the companies, and technology and research is already going on India is still at the nascent stage, you can say early stage in this artificial intelligence and robotics. In spite of that, most of the companies are using artificial intelligence, whether it is pharma company, whether it is FMCG company, or especially in the services, in the banking, insurance, they are now beginning to incorporate artificial intelligence in their day-to-day working. Because there is a recent, you can say, saying by an ICICI Bank spokesperson that at least 1 million banking transactions are done by the software robo per working day. So per working day, every working day, 1 million banking transactions are done by the, you can say, the software robo. So yes, the banking sector, various services sectors also using this artificial intelligence on a big way. So as a fundamental analyst, what will be your emphasis? The emphasis on to concentrate on those industries which are incorporating the new technology in their day-to-day services or day-to-day products, and they are continuously researching to upgrade their technology or trying to incorporating new technology in their day-to-day working. So that aspect also has to be looked into by a fundamental analyst. Okay. Any query regarding this? Okay. Now the techniques used in the industry analysis. Any query up to this, you can please ask. Okay. Now the techniques used in the industry analysis. First is regression analysis. Mansha is saying AI is helping us to make intelligent decision. Yes, true. AI is helping us to make intelligent decision, and it is also saving our time also. Now come to regression analysis. What is regression analysis? I will not go in deep into it because it is a statistical analysis. I will keep a glimpse of or to make you understand that how this process goes. In regression analysis, the dependent variable is basically forecasted on the basis of an independent variable. So you can say sales is forecasted on the basis of sales is forecasted on the basis of GDP growth rate. Sales of the particular industry is forecasted on the basis of GDP growth rate. So in this case, the GDP growth rate is basically a independent variable, and this sales is a dependent variable. So this dependent variable sales is found out on the basis of an independent variable, which is a GDP growth rate. I hope this is clear to you. Now I'm rubbing it, and I will just goes to the input-output analysis. Okay, input-output analysis. Input-output analysis is basically a method of analysis in macroeconomics which observes the interdependence between various sectors of the economy. So input-output analysis is the analysis which shows the interdependence between the various sectors of the economy. So which sectors comes to mind which are interdependent? I will take an example. Let us take the example of automobile industry. Or we can narrow it down to, for example, the manufacturing of cars. Manufacturing of, you can say, cars. For cars, let us take car is an, you can say, an output, a final product. A car is manufactured, a final product. In this car, various, you can say, inputs are used. In car, steel is used, aluminium is used, plastic is used, and electronic is used. Electronic gadgets are also used in car. Electronics are used. So prices in any one of this output will affect the input also. For example, if the prices of steel increases because of high demand of the infrastructural push, the prices of steel, for example, increases. So this will also affect the price of the car also. If there is a slight increase, then it will not impact much. But if there is a huge increase in the prices of steel as well as aluminium, so it will affect the prices of cars also. So there is interdependence between the prices of the various sectors. So as a fundamental analysis, you also have to see that what is the impact of one sector on the other, or interdependence between the you can say two or more sectors. In input, excuse me, in input output analysis, there is a three impacts. First is the primary impact. First is the primary impact. What is the primary impact? Primary impact is this, what I have explained, that if the prices of steel, aluminium increases, it affects the prices of the car also. Now come to the secondary impact. Secondary impact. For manufacturing of cars, various workers have to be employed. Fine. And then if the manufacturing of car increases, then the company will require more money because you have to finance this purchase. Na? So financing this purchase, it will, you can say, take the help of the bank, because you have to take loan from the bank also. And then the insurance companies will also come into picture, because the insurance of cars have to be done. So basically, the secondary impact will be on the banks. So because of this, you can say, increase in the production of cars, the more and more companies will likely to take loan from the banks. So on banks, it will be the secondary impact. Now, final impact, that is tertiary impact. Tertiary impact, or the last impact. The tertiary impact will be on the workers. The workers who are working because of the, you can say, increase in the manufacturing activities, more and more workers will be hired. So if more and more workers will be hired, they will be given more, they will be given salaries. And also because of this company's objective to increase its sales, senior executives will also be hired from other companies, and also the salary of the existing senior executives will also increase. So what will be its impact? It will its impact on the other sectors, and also other sectors also, by way of increase in consumption. The consumption will also increase now, because people are getting salaries. The existing people are getting higher salaries. So they will purchase some other goods. Their consumption will increase. And as we have seen in the economic analysis, that if the consumption increases, it will increases the demand. If demand increases, then the companies will likely to produce more. If the companies are likely to produce more, it will increase its sales, it will increase its profitability, and ultimately its share prices. That share prices will also likely to increase because of this process. So this is the third impact. So what is input output analysis? Basically, input output analysis is basically the shows the interdependence upon various sectors of an economy. For example, car, in the manufacturing car, various sectors are dependent, that is steel, aluminum, plastic, electronics. Increase in prices of any of this sector will increase the prices of cars. This is the primary impact. Secondary impact is that workers are hired, and then companies have to approach the banks for loans. So on banks and insurance companies, the impact will be indirect. Tertiary, or the lasting impact, will be on the overall other sectors also, because the workers which will be hired will get salaries, and the existing employees will also get higher salaries. So they will invest, or they will consume in goods in other companies also. So company sales will increase, and this way the other companies will also be positively impacted. So this is what input output analysis is. Any queries? Up to that, yes, Mansa, you are correct. That is the input output analysis. First aspect method it impact the product. Secondly, it actually impact the you can say the impact the process. More and more workers will be hired, and the banks will be impacted. Services will be impacted, and the third, the people will be impacted. That is, the workers will be employed, so they will get salaries, and by this, other sectors will also be impacted. So, correct conclusion on your part, Vincent. Fine. So I will take a, brief break of about 10 minutes, 10 to 15 minutes, and we will come back after the break. If any queries, you can jot it down and you can ask after the break. So I'm taking a brief break of about some 10 to 15 minutes. Okay, welcome back after this break. If you have any queries, please ask. Otherwise, I will proceed to the company analysis. Up to industry analysis, we have seen how this goes. So, up till this point, we have seen economic analysis and the industry analysis. Economic analysis, so generally as a fundamental analysis, proceed through the economic analysis, then industry, then the company. As an economic analysis, sees the GDP growth rate, the interest rate, the unemployment, the world economy as a whole, how will it impact the India. So these sort of things, the you can say uh, economic analysis as a fundamental analysis in the economic analysis scene. Then it comes down to the industry analysis, that which industrial sectors are likely to do well. The industrial sector which are having big infrastructure push by the government, and the sectors which are in the government PLI scheme, and the sectors which are giving further boost by the government, that is electric vehicle sector. So these sort of industries are automatically comes to the mind are likely to do well. So but out of these industries, which companies to select? So then comes the company analysis. So just please read this slide carefully. That economic and industry framework provides the investor with the proper background against which the particular company are purchased. So it provides a proper background. And this requires careful examination of the company's quantitative and qualitative fundamentals. Okay. First thing, I will take the quantitative factors, and then I will take the qualitative factors also, which is the management of the company. First is net worth and book value. Net worth and book value, consist of companies' equity share capital, preference share capital, and the company's reserves and surplus. Okay. Net worth and book value are all the same. In analysis, this generally done is market price upon book value, market price per share, and book value per share. This is generally employed by the fundamental analysis to judge whether it will be beneficial to purchase the shares of a company. Market price per share upon book value per share. For example, if the market price per share is 10, the book value per share is 30. Then the market price comes to 20, and book values, you always take it as 10. So you can say that this is the company's now share prices are cheaper, that is cheaper to buy. So you can say lower ratio of this market price per share upon book value per share. If it is lower, then it indicates that it is a time to buy. But this is not a, you can say, foolproof strategy on the part of the fundamental analysis, because the book value figures are historical figures. Now come to sources and uses of cash. So instead of using sources and uses of funds, I will use it as sources and uses of cash. That is cash flow analysis. And cash flow analysis or cash flow in statement is a very, very important factor which the fundamental analyst has to take care of. Cash flow statement. Cash flow statement, there are three aspects, that is cash flow from investing activities. First of all, it is cash flow from operating activities. Cash flow from investing activities and cash flow from financing activities. Okay. This cash flow from operating activities, when you see the financials of a company as a fundamental analyst, the cash flow from operating activities should always be positive. And the cash flow, the total cash flow, the net cash flow by including all this operating, investing, and financing should also be positive. But this operating cash flow, in order to judge whether the company has a good cash flow or not, is that the operating cash flow should be positive. Most of the time, most of industry, the investing activities are generally negative because of the investment push. So the cash is going out. So in most of the companies, it is in practical situation, it is negative. Financing activities are also in most cases, negative because the companies are declaring dividend. The companies are going out with the buyback issues. For example, in the case of IT companies, the cash flow from financing activities is negative because of the huge dividend given by the this IT companies, the TCS, Infosys, Wipro. So their cash flow from financing activities is in the negative. Investing activity is negative because of the investing activities. But operating activities means from the company's operation, it should be positive. And the net cash flow, preferably, it should be positive after this operating, investing, and financing activities. Now, let us take a practical example to understand this better. Let us take this example of existing Tata Consultancy Services itself, TCS. Let us see this TCS's cash flow statement. I hope it is visible to you. Cash flow. So if you see that the Tata Consultancy Services cash flow from operating activities, it is positive in all the years from starting from this March 2000. You see my cursor, March 2012 to March 2023. It is positive. And as I explained before, the cash flow from investing activities is in some cases it is negative, in some cases it is positive. But cash flow from financing activities, in all cases, it is negative. It is because of the huge dividend. We see the cash flow from financing activities. Just for the clarity, that is here. The dividend paid, if you see cash flow from financing activities, dividend paid, very high dividend paid. In March 2023, the dividend paid is this 41,410 crore actually. So financing activities is negative in case of IT companies because of this huge payment of dividend and buyback also in some cases. In some year, that is in March 2022, the TCS's cash flow from operating activities is positive, 39,949. As usual, investing activities and financing activities are negative. And net cash flow is 5630 in March 2022. It is also in the positive. So you can see that yes, the cash flow situation of the TCS is more or less good. Okay, so this is what is cash flow analysis. Now come to cross-sectional and time series analysis. Cross-sectional time series analysis. In this case, basically, what is to be seen is ratio analysis and the common sized financial statement. Common sized statement. Common sized statements. So in this way also the position of the company is judged by way of ratio analysis. You know the ratio analysis. I will be taking few ratios further in the later discussion. Common size statements, you know that in case of profit and loss account, various figures are seen, means given in comparison to sales, means expenses, how much expenses are in comparison to sales, how much profitability in comparison to sales. And in case of common balance sheet, various figures are compared in relation to assets, that how many percentage of fixed assets are in comparison to total assets, then how many percentage of current assets are in comparison to this total assets. So by way of ratio analysis and common size statements, basically the of the past 5 years, 10 years is made in order to judge the company's performance. Now come to size and ranking. Size and ranking also gives you an understanding that whether it is profitable to invest in such companies on the basis of size and ranking. I will take a few examples to illustrate this. See, in case of TCS also, Tata Consultancy Services, here, if you see that peer comparison is given in case of TCS, peer comparison. I hope it is visible. Wherever it is not visible, you please tell me, okay? I hope it is visible to you. Peer comparison, TCS Limited. Here are the various companies, TCS, Infosys, HCL Technologies, Wipro, various companies are given. You can easily see that TCS is the leader in the IT companies. The market capitalization, see the market capitalization, huge. By way of, and sales also. By sales figure and the market capitalization figure, you can judge the size of the company. So TCS is the leader in case of this IT companies. This Infosys is the, you can say, distant second, and then HCL, and then Wipro. So this, you can say, size and ranking also helps you in taking a decision as a fundamental analyst. Then come to growth rate. In growth rate, the various aspects have to be taken care of. Okay. But how to judge the growth rate of a particular company? First, seeing the growth rate of sales, then the growth rate of net profit, that is net profit after tax, EPS, earning per share, then growth in capital, growth in capital, as well as fixed assets, growth in capital, as well as fixed assets. This is very important, students, that if the capital is increasing and there is no growth in fixed asset, it means it is a red flag. It means the company is not doing well. Because why there is growth in capital? The company has taken capital in order to grow, in order to invest in the various investment opportunities in its fixed assets, etc., in its investments. But if the company has taken money and it is not investing it in the fixed assets and the various investment opportunities, then there is a red flag that there is something wrong in that company. So there is a very good way to judge that if the capital is increasing, the fixed assets must also be increasing, and simultaneously sales is also increasing. Because if production is taking place, then it also, in order to increase the production, fixed assets has been increased. So if production is increasing, then the sales must also increase. And then the various factors, that is companies return on capital employed and the company's return on equity. So sales figure we have seen in the case of TCS also, the company sales figure, net profit after tax, and EPS. You can also, if the net profit after tax, EPS, return on capital employed, ROC, return on equity, ROE, is also increasing. If in case of a particular company, these factors are increasing, then you can say that yes, the company is actually doing well. And one factor which is to be given a special emphasis is the growth in capital as well as growth in sale, and as I have said, in sales also. Sales I have already given here, but if capital is increasing, then there should be a growth in fixed assets. And if there is a growth in fixed asset, then it should percolate in sales also. So sales is interrelated to this. Okay. Now come to the next point, which is financial analysis. Very important. So I will take a separate sheet to explain this, the financial analysis in case of company analysis. Financial analysis. I will write it here again because that is the next page. I have financial analysis. Now, in financial analysis, what has to be seen? The first aspect, and first and foremost, the company's profitability situation. Profitability. Then company's liquidity. That is whether the company is able to meet its short-term obligations or not. Then company's solvency. That whether the company is able to meet its long-term obligations or not. And then lastly, the company's cash flow. Okay. We will take one by one. First of all, take the profitability. Profitability, what to see? Sales, company's profit, company's EPS, company's return on capital employed, ROC, company's return on equity, ROE. Okay, let us take a practical example. And let us take a different company in spite of Tata Consultancy. Any company which comes to your mind, just take Asian Paints. Okay. Yes. Yes, true. Companies also using the buyback as a tool to increase the share prices. True. Okay. Yeah. Asian Paints. See, Asian Paints compounded sales growth. 10 years, it is 13%, near about 15%. Compounded profit growth of TCS, of Asian Paints, last 10 years, 14%. 5 years also 15%. So more or less this Asian Paint is consistent in 5 years, last 5 years, for last 10 years, near about 15% growth rate in sales as well as profitability. Return on equity, very good. This is 27%. And return on capital employed, we will see. Return on capital employed, 34.4%. It is also very good. And if we see the EPS is also likely to be increased because all these factors are increasing, then obviously the EPS is also increasing. See, the EPS figures for the last few years have been increasing all the way, the CPS. Okay. So on profitability count, this company is good. So student, I just want to clarify in this case that these are only for the example purposes. Please don't take this as a recommendation. This is also only for explanation purpose only. Okay. Now come to the next aspect, which I said liquidity. So in liquidity, which factors to consider in case of liquidity? Liquidity. Okay. Liquidity. First is current ratio. Current ratio general industrial practice is 2:1. But it is not actually a hard and fast rule. It depends upon companies to companies. Some companies it is even 1:1 also, or some companies it is less than 2:1 also. It depends upon how much the company is, you can say, how much is the requirement of such companies. Current ratio, no, current assets upon current liabilities. So it is not a hard and fast rule. General industry practice is 2:1. Second is liquid ratio. It should be 1:1. Again, this is not a hard and fast rule. It depends upon particular industry to industry. And last but not the least, one ratio to judge whether the company is liquid or whether the company is able to meet its short-term obligation or not is interest coverage ratio. Interest coverage ratio. And interest coverage ratio is, calculated by way of EBIT upon interest. As a fundamental analyst, you want to take safely, you want to play safe. So at least the interest should be, we can say, EBIT should be at least 3 times. EBIT at least should be thrice of the interest. मतलब इतना बफर तो होना चाहिए EBIT का, अर्निंग बिफोर इंटरेस्ट एंड टैक्स का, कि वो इंटरेस्ट के अमाउंट को सफिशिएंटली कवर कर दे, इंटरेस्ट एक्सपेंस को, शॉर्ट टर्म ऑब्लिगेशंस को, मतलब इंटरेस्ट को कवर करने के बाद भी काफी बफर बचे. सो दिस इज नॉट अ हार्ड एंड फास्ट रूल अगेन, बट as a precautionary measure, the fundamental analyst may take it as 3:1. That is EBIT at least thrice of this interest in order to play safely. Now we will see this with the help of a practical example. Asian Paints, let us see. Interest coverage ratio. Now come to the profit and loss figure, interest amount. Interest amount, it is very less. If you see March 2023 figure, March 2023, interest expense 144. Interest expenses 144, and your operating profit is 6260. So it is very less, interest is. So it is sufficiently covering the interest. And just give a brief glance of the current ratio or liquid ratio also. Current ratio, if you see the other assets figure and the other liabilities figure here. Other assets figure, other liabilities figure. If you see that the assets are sufficiently covering the liabilities. Okay. So on the liquidity front also, this company seems to be more or less good. And then comes the solvency part. In solvency, what to be considered? Sorry. Solvency. The first and foremost ratio comes to mind is debt equity ratio. Okay. Debt equity ratio. That is debt upon equity. General practice it is actually 2:1. That is, debt should be twice that of equity. But again, this is not an hard and fast rule. Generally, in case of manufacturing companies, the debt is high because there is constantly capital expenditure, maintenance of capital expenditure. Therefore, the debt is generally high in case of manufacturing companies. But in case of other companies, that is services companies, for example, IT, the debt is generally very low, or sometimes it is negligible. I will take an example that debt equity ratio of 2:1 is not a standard practice, and it is varies from companies to companies. And the current trend is that most of the companies, even the manufacturing companies, are now trying to reduce their debt. Let us take the example of an IT company. Any IT company, Infosys comes to your mind. Let us take the example of Infosys. Just give me a second. Yeah. So if you see Infosys in the borrowing section, the borrowing is here in September 2023. It is visible to you. 8546. 8546 is the borrowings. And this equity, that is equity share capital here, equity share capital 2070 September 2023 and 78,698. It is very high in comparison to debt. So debt is almost negligible in case of IT companies. If you see other IT companies also, the debt is very negligible. If you see any manufacturing company, the debt equity ratio will vary. Debt will be high. Let us say Larsen and Toubro. To see Larsen and Toubro, balance sheet. C, borrowings. Borrowings are high. C, September 2023, 1,22,109 crores borrowings, debt, and equity and reserves are less. So the moral one point, the ratio is tentatively coming to about 1.5 is to 1. So in manufacturing companies, the debt is higher. And in case of services companies such as IT, the debt is lower. So it depends upon company to company. But generally, the aim of the companies is to keep their debt high. So fundamental analysts generally tend to invest in such companies where the portion of debt is low and so that solvency position of the company is good. Okay. Now come to cash flow. Cash flow, I have already discussed that the company's net cash flow from operating activities, it should be in the positive. If it is positive, it shows that the company has good cash position, short-term cash position of operating activities. And then the net cash flow, net cash, after all the operating, investing, and financing activities, net cash flow should also be always also be positive. If all these criteria meet, the fundamental analysts generally make a view that yes, such company is actually a good investment proposition. Any question in that, students? Now, now come to competitive advantage. As I have said that before this starting of this fundamental analysis or going into detail into fundamental analysis, that is two factors which the investor has to take care of before beginning this fundamental analysis. First is general observation and second is modes. General observation I have already discussed. Modes is competitive advantage. That is the example which I have given is Royal Enfield bike. It is a mode. It is a competitive advantage. Even if the bike prices of bike is increased, the bike lover will purchase it. So, as an investor, tend to look for such companies which have competitive advantage. If you see the companies which have competitive advantage of brand is Apple, Microsoft, Google, Amazon, Tesla, and actually these companies are actually, you can say, dominating the global markets. So, and in India, there are as many as brand recall value, the various brands which you can easily recall. This is Colgate, can say Lux, because many people say that yes, they do not tell that yes. Sometimes people say that yes, brush karna hai. They do not say brush karna. They say Colgate karna. So Colgate is such engraved in the minds of the consumers that it has a huge brand value. And this Lux, Colgate, these companies are generally likely to flourish because of this, the competitive advantage or the moat. Now comes to quality of management analysis. Students, this is a very important part. Management and analysis is as important as financial analysis, and some fundamental analysts put this management analysis in front of or in, you can say, in preference to this financial analysis. So let us see management analysis or quality of management. Yes, Starbucks, true. No. Management analysis or quality of management. Management analysis, the first thing you see the companies who are in the senior management must be of skilled people. So you see skills, integrity, and experience. But sometimes it is difficult to, you can say, gauge or difficult to find out whether the management is actually good or not, because many things the management do not disclose to the public. You as an investor may not come to know what the management is planning or what is going on in the senior people of the management, such as the CFO and the CEOs and the CXOs. So how to find it out? It has to be find it out through the conference call. This is the way out. Conference calls. Sorry. The way to find it is through conference calls. So what is this conference calls? Generally, after the annual general meeting or certain important extraordinary general meeting, the CEOs of the company generally held a video conferencing with the investors, or they generally held a one-to-one with the investors. And this is generally recorded also. In this, the investor may ask any questions. So they have to answer in such situations. So as an investor, if you see the conference call, or if you attend the such things, or if you see the recording of the conference calls, you can judge that what is in the mind of the senior people. That is what the company is planning to do, what the company is expected to do in future. So these conference calls are very important. Another important document which the investor as a fundamental analyst must see is the management discussion and analysis report. Management discussion and analysis report. So in this management discussion and analysis report, various important factors are generally discussed and are given. It is a part of the company's financial statements. And in this, the company's business environment and risk management, the segment-wise performance of the company, the capital and exploration expenditures of the company, the taxes, the environmental matters, uh, the various risks, that is market risk, inflation, other uncertainties, which may affect the companies are also discussed. Critical accounting estimates relating to valuation of oil and gas reserves, asset retirement obligations, consolidations, litigations, contingency tax, foreign currency translation, all these things are given in the management discussion and analysis report. So a fundamental analyst must go through the company's management discussion and analysis report to find out about the efficiency of the management. And then after all this comes the background check. Comes the background check. So how to do this background check? What to include in it? Background check में क्या क्या होगा? In background check, first of all, who are the company's promoters? Who are the company's promoters? Who are the company's directors? How many directors are independent? How many directors are whole time? Means they are whole time employee of the company. Management succession plan. Whether the company has a good management succession plan, that is, whether the company is grooming its existing CFOs and CXOs to become the next CEO. If the company has such a policy, that also has to be found out by the fundamental analyst before investing, or before we can say having an idea about the effectiveness of the management. Uh, Some companies can come to your mind that which have a good management succession plan, such as TCS and Infosys have good management succession plan. And another important factor in management analysis or to judge the, can say the quality of management is, sorry, is salary of promoters, salary of promoters versus net profit. Just make it clear. Salary of promoters versus net profit. This is an important factor, students. If the net profit, the company's net profit is increasing, and the company's salary is also, and the salary of the promoters, or the, you can say, the salary of the biggies of the company, that the CEOs, CXOs, and CFOs are increasing, well and good. But if the company's net profit is declining and the salary of the employees are increasing, so this is actually a red flag, as it has happened in the case of ILFS, Infrastructure Leasing and Financial Company. In ILFS, the same situation happened, that the net profit was declining, the profitability was less, but the salary of the promoters was increasing. So it has to be checked by the fundamental analyst that if the profit is increasing, then the salary of the promoters, in that situation, only the salary of the promoter should increase. Otherwise, not. Then another important factor is project execution. Project execution. With how is the situation of the company's project execution? If the company's project have been executed well, this also shows the efficiency of the management. Whether the management is consistently paying dividend. This is also an important factor. It is not obligatory, as you know, it is not obligatory on the part of the companies to declare dividend every time. But the good companies, in order to satisfy the investors, generally tend to declare dividend every time. Good dividend paying companies, it constantly come to your mind, that is Asian Paints, Dabur, ITC, and all the IT companies. So they are basically good dividend paying companies. So it also shows the efficiency that the management is consistently declaring good dividend. And sales is, this is last but not the least very important point, that sales is increasing because of sales volume and not prices. Sales is increasing because of sales volume and not prices. This is a very important factor. If sales is increasing because of selling price and volume is not increasing, it means quantity of the sales, quantity of production is not increasing, then it is a red flag. It means something is wrong, because if sales is increasing, then production should also increase, quantity of sales should also increase. If it is not increased, then it also a red flag. And it also shows the efficiency of the management. Okay. So these are the factors which has to be checked in case of management analysis. That is, first of all, the skills, integrity, and experience of the management. Conference calls which the CEOs of the company, the managing director of the company held after the annual general meeting or extraordinary general meeting, that has to be looked after by the investors to know what is going on in the minds of the, you can say, company. Management discussion and analysis report, it is part of the financial statement, has to be checked by a fundamental analyst in order to judge the efficiency of the management. Then the fundamental analyst should do a background check, that is, who are the promoters, who are the directors, how many directors are independent, how many directors are whole time. Management succession plan, that is, whether the company's existing CFOs, CXOs are equipped enough, good enough to be the future CEOs of the company. salary of the promoters versus the net profit. If the salary of the promoters is increasing because of higher net profit, very good, otherwise not. Project execution, whether the company is executing its projects efficiently or not, that also you can say showcases companies management efficiency. Then whether the company is consistently paying good dividend or not. And then last but not the least, that the sales is increasing not because of sales price. Sales price will increase, that is well enough, but only not because of sales prices, but also because of sales volume. So this is a very important factor to check the efficiency of the management. Okay, any queries? Yes, definitely. ESG, that is environment, social, and governance, also part of this. This is a recent trend that it also shows that the company is committed enough. And this also ESG is part of the corporate governance, which I'm just about to take. That corporate governance. I will take in a separate sheet. There is corporate governance part. Corporate governance. So this recent trend, that is ESG, which is environmental, companies, environment, social, and governance factors. So this is also a part of the company's corporate governance initiative, and now it is actually you can say regulatory. So I will take 2 points simultaneously. There's the company's, you can say, corporate governance and regulation. These are interrelated. So I will take these 2 points simultaneously: corporate governance and regulation. Company's LODR, that is listing obligation and disclosure requirement rules. SEBI's listing obligation and disclosure requirement rules. Companies ICDR, issue of capital and disclosure requirement rules. So this has also have to be seen then by the investor, that is whether the company is complying with these regulations from time to time or not. So these are very important. And then as a regulatory part, the fundamental analysis has to see that the company is also fulfilling it, the other acts also, compliances on the other acts. That is Companies Act, SCRA Act, Securities Contract Regulation Act, SEBI Act. And if the company has branches abroad, then the companies, you can say FEMA also, FEMA. Then FEMA, compliance of FEMA is also important in such situation. If the a company has, you can say, is exporter or an importer, then compliance of FEMA regulation, that is Foreign Exchange Management Act, is also very important in such cases. Any queries, students? Now come to location and labor management relations. This location and labor management relations are very important now. Earlier, the investor do not take much importance into it, but now it is also carefully looked after by the investors. This labor management relations. As you have heard that there is a 2 years back there is a labor management strife or dispute between the labor and management in the Manesar plant of Maruti Suzuki. And this has become, you can say, uh, news, hot news in almost every newspaper, every news channel. So this, such aspects has to be avoided by the management, and management should be careful because such situations such as the labor management, poor labor management relations are generally perceived by the investors. So, in these cases, the company has to be very careful, and this aspect also has to be looked after by the fundamental analyst. That is the location, that is proximity of the, you can say, company's office from the, you can say, the factory or such situations, and the good labor management relations. Now come to the company analysis. Now another part, next to part, pattern of existing shareholding. This is also important, students. This is pattern of existing stockholding. That is whether and the base to judge, analyze a company is by seeing the promoter shareholding. That whether the promoters are increasing their shares or whether the promoters are decreasing their shares. I will give you an example. Pattern of existing shareholder stockholding. See, in Larsen and Toubro again, we will see the share here, shareholding pattern. If you see shareholding pattern, the FIIs have slightly reduced their shares. So this is all right. Public has also, the pattern of shareholdings also gives you an idea. See, FIIs, more or less the shares have increased by, FIIs have decreased a bit, but domestic institutional investors have increased 13.16 to 37.34, 37.16 to 37.34. Government shareholding more or less same, and this public shareholding more or less, the pattern of shareholding more or less same for the last few years. So it actually, the pattern of shareholding is also, it actually shows the stability of a company. Okay. If there is too much, you can say rejig in the shareholding pattern, too much increase or decrease in the shareholding pattern, it it shows that the, you can say, the dominant shareholders such as foreign institutional investors, domestic institutional investors are not happy with the company. If they are increasing their stakes suddenly and they are decreasing their stakes suddenly, then there is a, this is a red flag. And then comes to the marketability of the shares. Actually, marketability of the shares is, you can say, related to the other factors which we have discussed. Okay. That is marketability if the share price is increased. And share prices increase, it depends upon the various factors. It start from economic analysis, that's company's GDP growth rate. And then it comes to the industry analysis, the push by the infrastructure, push by the government, the industries are likely to do well. And then it comes to the company analysis, in which the company whose financials are good, whose management is effective, is likely to do well, then their company share prices increase. So it also is the, then the marketability of the company is increased by this. Now come to the various techniques used in company analysis. It is correlation, regression analysis, trend analysis, and decision tree analysis. So correlation, what correlation indicates? Correlation generally indicates the, you can say, correlation between the industry and company return. Correlation between the industry and the return of the company. And trend analysis is generally related to this. Trend means 5-year trend. For example, 5-year, or a 10-year trend is observed, that what is whether for the last 10 years, the particular companies, for example, Tata Consultancy Services, uh, is company return is in, you can say, in comparison to this industry return, that is the IT industry. So this way, the you can say judgment is done in case of company analysis. This is the correlation analysis. And regression analysis, this is again a statistical technique. In regression, as we have seen that the dependent variables are found out on the basis of the independent variables, such as, let us take an example. Mm, incentives, incentives under government PLI scheme, that is production linked incentive scheme, its relationship, it is actually an independent variable, incentive, and its bearing on the profit of, or you can say to be more specific, production of such companies. So you can say a regression analysis can be done. On the basis of this, the production of companies can be forecasted. The production of the company can be forecasted on the basis of incentives given under the PLI scheme. For example, mobile manufacturing. Certain companies are engaged in the domestic companies are engaged in the mobile manufacturing under the PLI scheme, production linked incentive scheme, under the government is giving incentive to such companies. So the whatever incentive is given, for example, 10 crore, 15 crore, whatever amount is given to such companies, on the basis of the incentives given, whether the production of such companies are increasing or not. So that is generally uh, whether the production of such companies will be increase or not in the future. And such data is generally analyzed over a period of time. That's, for example, first 5 years or 10 years. Then, in such situation, the trend analysis will come. Trend means a certain trend is observed for 5 years or 10 years. Okay. So, this is what is company analysis in case of correlation, regression, and trend analysis. Lastly, in this company analysis, I will take the decision tree analysis. I will take a separate sheet to explain this decision tree analysis. So what is a decision tree analysis basically? Decision tree analysis is basically helps in the evaluation and comparison of various options and their results shown in the form of a decision tree. So I will repeat again, what is a decision tree analysis? Decision tree analysis is an analysis which helps in the evaluation and comparison of various options, evaluation and comparison of various options and their results shown in a decision. So let us take an example, evaluation of various options. First option is, will company's profitability will company's profit increase in future? In say 5 years, in 10 years, in 15 years. And in 5 years, whether the company's profit will increase to, what is the chance that company's profit will increase to 10% or 15% or 20%? Similarly, what is the chance that the company's profit will increase in future in 10 years by 10%, 15%, and 20%? Similarly, what is the chance that the company's profit will increase in future in 15 years by 10%, by 15%, and by 20%? Say company's profit will increase in future in 5 years by 10%, and 10% chance is that chances of company's profit increase in 5 years by 10% is, you can say, let us say it is 70%. Let us say it is 60%. 60%. Chances that company's profit will increase by 15% in 5 years. The chances are 25%. It will increase by 20%, the chances are less. It is about 15%. Now, medium term, medium to long term, 10 years. Company's profit will increase in future in 10 years by 10%. What are the chances? Chances are, let us say, in 10 years, the chances are bright, 70%. 15%, not that much, 20%. And it will increase in 10 years by 20%. Company's profit chances are only 10%. What about 15 years, long term? How much company's profit will increase? In 15 years, it will increase by 10%. Chances are 80%. 15% chances are 20%. And in 15 years, company's profit will grow by 20%. The chances are almost zero. So this way the decision tree is generally done. So decision tree gives you can say an option, a clarity, or you can say various probabilities on the basis of which an investor, as a fundamental analysis, can take decisions in 5 years period, in 10 years period, and 15 years period. Okay. So this is what decision tree analysis is there. Any question, please ask. Uh, See, chances of negative growth, yes, the negative growth, if there is a growth is, if there is a negative growth, then obviously it will impact the various other sectors. Negative growth rate in the sense that how will you judge the negative growth rate? If the negative growth rate in the GDP, then it will affect the entire economy. It will affect the most of the industries and ultimately most of the companies also. It is, if there is a negative growth rate in certain industries, it will affect some of the companies in such industries. If, for example, if the prospect of negative growth rate, negative growth in the, you can say, steel sector. So then the steel companies will be, some of the steel companies, or most of the steel companies will be affected. If you see, if your question is about growth rate on company analysis, the company's growth rate is negative on the basis of, you can say, sales are not likely to increase much. Profitability position is not good for the last 5 or 10 years. Liquidity position is unstable. Solvency position, company sitting on a very high debt, pile of debt. So this, you can say, the prospect of company's growth rate is on the lower side or on the negative side, you can say. So it is not, as a fundamental analyst, it is not feasible to invest in the shares of such companies. So it depends. Negative growth rate on the point of view of economy, negative growth rate on the point of industry, and negative growth rate on the point of view of company. Okay. So shall I proceed further? Now, please attempt this MCQ multiple choice question, that dash is not a part of fundamental analysis. By excluding one of the options, you can easily tell that which is not part of the fundamental analysis. So you can go through it, students. Try to attempt this, that dash is not a part of fundamental analysis. Yes, Vansha. Yes, Manjuta. That's very correct. Bar chart analysis is a part of technical analysis. So the correct answer is bar chart analysis. So bar chart analysis is not of a fundamental analysis. We have seen that economic analysis, industry analysis, and company analysis are part of fundamental analysis, which is also called EIC analysis. Now, try to attempt the red flags and warning signs to be considered by the investors. Last but not the least, these points are also very important, and these should be considered by the fundamental analyst. First is, if a company is purchasing raw material from one related party and selling it to another related party, then it is an early warning sign. Yes, it is a warning sign because uh, companies are transacting between them only, not to outsiders. So it seems that something is wrong. Then, with regard to loans and advances, loans are taken from a financial institution and given to a subsidiary. So it is also a method of siphoning of the money. If loans and advances are taken and given to a subsidiary. Another red sign, red flag. If huge investment is made in fixed asset, but the sales of the company are not increasing and production capacity is not increasing, it is a warning sign. I have discussed also that yes, the if investment in fixed assets, plant and machinery has been increasing because the company is trying to produce more. But if it is not reflected in the production, if substantial amount has been invested in the fixed assets and the company's production is not increasing, company sales is not increasing, then this is a red flag. It means the company is trying to siphoning of its money or trying to, you can say, fool the investors. Another warning sign is that huge investment is made in a subsidiary and the objective of the holding company is not aligned with the objective of the subsidiary. So the objective of the holding company and the objective of a subsidiary should be aligned. If it is not aligned, and huge investment is made by the investment to the subsidiary company, huge amount. So it means that something is wrong. Because if the objective is not aligned, then why the holding company is given substantial amount to its subsidiary? Subsidiaries in tax havens with no requirement of maintenance of books. Subsidiaries have been formed in tax havens such as Maldives and Cayman's Island and such other, you can say, places where there is no requirement of inspection of the books of account. But the question of the fundamental analysis should be that why the company should resort to such practices. Why the subsidiaries should be established in such tax-free havens when where there is no requirement of the inspection of books of account. So this is a red flag. Now, sales are declining, but fixed assets are increasing, giving an indication that fixed assets are not properly utilized in the operating activities. Again, this is in relation to the earlier point which I have mentioned that fixed assets are increasing. Fixed assets are increasing means companies are trying to increase its production. But if the production is not increasing and sales is not increasing, but fixed assets are increasing, but sales are declining and production capacity is also declining. It means the company is, it is a red flag. Company is not efficient enough, or the company's efficiency is down, or it is trying to siphon up the money. Now, the company has unpaid tax liability, but is regularly paying to its related parties. Company has unpaid tax liability, it has not paid its taxes, but it has money when it comes to paying to its related parties. So this is also a red flag. And last but not the least, abrupt resignation of auditors. Auditors have resigned. This is also a red flag because no auditor is willing to resign, or you can say tend to resign during midway. So if any auditor has resigned abruptly or in the mid of the financial year, then it signifies that something is wrong in the company. For example, in case of 2024, you can say the auditor resigned. I think near about, I think 20 to 25 auditors have resigned. This is an approximate figure. It is less than 2022. It is less than 2022 and 2023, where it is more than 50, where it is more than 50. So, less number of 2023, 21, and it will be 22. So, less number of auditors have resigned in 2023 in comparison to 2021 and 2022. So, thank you so much. I will be taking you the assignment in brief quickly. Before that, if you have any query, you can please write. You can please ask your queries on the viewers mobile app. You can ask your queries on the mobile app, or you can also call us at 0120 3045 956. I will again repeat 0120 3045 956. So you can call at this number, or alternatively, you can also download the viewers mobile app and put your queries there. We will happy to answer your questions. Yes, another question. Yes, your point is correct. Yes, if the holding company or parent companies, if the holding company or parent companies is taking loans and giving it to subsidiary, and subsidiary is giving a meaningful work, and objective of the thing, you can say parent company, holding company, and the you can say subsidiary company is in sync. So well and good. This is not a red flag. This is actually good. The subsidiary is also prospering along with the parent company, but the red flag is arises in such situation where the subsidiary is giving loan, the holding is giving loan to a subsidiary, and subsidiary is siphoning its money to other places, Cayman Islands, Maldives, etc. So such situation is actually grave, and such situation reflected when the company is holding company is blindly giving money to the subsidiary, and the objective of the two companies are not aligning. Okay. And subsidiary is also not doing substantial business also. In such situation, it is a red flag. Otherwise, this is good. If the objective of the holding and subsidiary are aligning, and subsidiary is doing a meaningful work, is doing a good business, showing profitability, then very good. Okay. So I will come to the assignment quickly. Now, uh, let us come to, I think assignment is visible to you, everyone. Ashokji, assignment visible है ना? ठीक. Okay. Now come to the first question. India's GDP growth rate is expected to decline this year. Okay. Considering the present situation, what will be your likely forecast for the India's economic situation? If you see that some of the rating agencies have projected declining growth rate, and some of the agencies also projected higher growth rate also. So you have to be conversant with what is happening in latest. So you have to read the good financial newspapers such as Economic Times or Mint, Business Standard, Business Line, and you should be conversant that what is actually happening in the economy and what is projected to happen. So according to India Ratings and Research, according to India Ratings and Research, India's GDP is projected to be increased from 6.2% to 6.7% actually. So if this is projected to be increased from 6.2% to 6.57%, what will be its repercussions? Repercussion will that it may lead to it will lead to more of the sectors will likely to do well, because more and more industries will likely to invest, will likely to produce more, will likely to employ more people. So people's job are likely to increase because of this, and you can say this will ultimately lead to the company increase in company's production, sales, profitability, and the share prices, as I have discussed beforehand. But there are certain caveats also. There are certain warning signs also. Because of the two situation which has to be take care or which has to be analyzed further by the fundamental analyst. These are the supply chain disruption. Supply chain disruption and volatile geopolitical situation. Volatile geopolitical situation. If you see that globally, what is happening? The inflation is increasing. Inflation is not increasing because of higher demand. If inflation is increasing because of higher demand, that is actually good for the economy. But inflation is not increasing because of higher demand. It is increasing because of supply chain disruption. There is disruption in the supply chain. Why? Because of volatile geopolitical situation. These 2 points are actually interrelated. Political geopolitical situation, there are various fronts in which the war is going on. First, you have seen it for some time that Russia Ukraine. Then one war front which is opening is China Taiwan. Other is Israel Hamas. Another front which is opening is Iran and Pakistan. And the tension in Middle East. Overall tension in Middle East. So because of this, the prices of various commodities will increase, or the nations will try to hoard commodities. For example, this Russia-Ukraine war has increased the prices of the wheat to a substantial extent. And the oil also, the oil prices will increase further. It is increasing presently, and oil prices will increase further also. So these supply chain disruption on account of war is creating the volatile geopolitical situation on account of war is creating a supply chain disruption. And because of the supply chain disruption, the inflation is increasing. So as I have seen that modest amount of inflation is good, but if the inflation is increasing too much, it will affect the total economy as a whole, because then the production will be less, the company's profitability will be less, and then sales will be less, more job losses, and it will be reflected in the company share prices also. The share prices of the most of the companies will be less. So these type of problem may percolate to India also. So these are some of the caveats in this analysis. Now come to the next question in the assignment. According to you, which industrial sectors are likely to do well in view of the present situation? We have already discussed this, that which industrial sectors are likely to do well in future. Tentatively, you can say the sectors which are giving huge infrastructural push, for example, the cement sector, the steel sector, the iron ore, the glass, the can say the wood, real estate companies, and the companies which are giving, which are under the PLI scheme, that is the government's production linked incentive scheme, and the auto companies which are giving more emphasis or more importance to the electric vehicles. So electric vehicles, the companies which are manufacturing electric vehicles are also likely to do well. Then I will come to the third question. Let us take this third question in front of you. I have already taken a practical example of this. Uh, Please try to attempt this. This is a very simple question. Profitable growth, if you see the sales growth, first of all, you compute the company's profitability. Okay. If you see that the company's sales growth is not that much, it is increasing, but not by a very high amount. EBIT is increasing, but not by a very high amount. If I try to open, so more or less, if you calculate the CAGR, the profitability, it is more or less going on the, can say 2 to 3%. The profit is growing. If you can calculate it, I'm just giving a figure that the company's sales is growing at 2 to 3% on an average. Company's EBIT is growing at an average of 2 to 3%. See in now company's profitability, then another factor, then liquidity. The company's interest expense. You compare the company's interest with the company's EBIT. If you see the company's EBIT is substantial in comparison to interest expense in all the years. This EBIT and interest, if you compare, the company's EBIT is substantial to cover the interest expenses. So you can say the company's liquidity position is more or less good. To further confirm it by looking at the company's current assets and the company's current liabilities. If you compare the current company's current assets with the current liabilities, you can say that the current liabilities also cover the current assets, covering the company's current liabilities by a substantial extent. If you compare the company's liquid assets, if you compute the company's liquid ratio, that is liquid assets, and the company's current liabilities, then also you see that more or less it is 1:1 on the pattern. So you can say the company's liquidity position is good. But if you see the solvency position, the company's debt and the company's equity. Company's debt is in front of equity. So if it is the manufacturing company, then it is okay. But if it is a services company, then it is absolutely a no. Okay, so it depends upon the company to company. Now come to companies cash flow activities. If you see the company's cash flow from operating activities is positive, so it is good. So companies, you can say company's liquidity position, liquidity is good. Liquidity is good. Company's cash flow is good. Company's liquidity is good. Company's cash flow is good. Solvency is on the higher side, and company's profitability is not that much. So if you are convinced, so as a fundamental analyst, if you are convinced about, yes, the management is good, the efficiency of the management is good, and it is likely to take the company further to higher growth, then the fundamental analyst can consider investing in this company. Otherwise, the fundamental analyst in general sense will likely to avoid this company because the sales and profitability growth is not that much. It is 2 to 3% only, sales and profitability. Okay. And the last section on this is assignment. While evaluating an annual report, point out the red flags that should be considered by an investor before investing by giving suitable explanation. So I've just discussed this. The main point is that I have discussed this twice also, that if the holding company is giving loan to a subsidiary company, the objective of the two companies should be aligned. If the holding company is giving loan to subsidiary company and the subsidiary company's objective is not aligned with the holding company's objective, and the holding company is not doing substantial business, then this is a red flag. If there is abrupt resignation of auditor, then there is a red flag. If the company's you can say fixed assets are increased, but the company's sales are declining, the company's production is declining, then it is also a red flag. And if the company is paying, has unpaid taxes, it has not paid taxes, but it is paying to its subsidiaries substantial money, and it is also a red flag. So these are some of the red flags which an investor should consider before investing in the shares of a particular company. I will take some of the queries which have just emerged. Yes, Manisha, correct. Cost push and supply side factors also contribute to inflate the prices. Correct. And Lakshadweep attraction also affecting India-Maldives relation. Yes, geopolitical. Suraj, this is a very good point you have explained that recently this is the India-Maldives relations have suffered recently, and this is Lakshadweep attraction is also affecting the India Maldives actually relations, and so this tourism sector is affecting. So the basic objective is to give the boost to the domestic tourism. So by this, as a fundamental analysis, you can say that yes, the domestic tourism is giving a boost. So some of the domestic companies may do well in future. Okay, fine. Any other query? Otherwise, I will wound up this session. So thank you so much, students, for your patient listening. I hope you enjoyed this session. Meet you again. Thank you so much. Thank you. And this is your contact number. If you have not noted it down, please you can note it down again. 0120 3045 956. And please download the BIOS mobile app and post your queries in case of any doubt. Thank you. Ashok ji.